Hey everybody, Rob Maurer here, and today we're of course talking about Tesla's Q2 delivery and production report, which Tesla released before market open today, and the market's reaction so far has been quite positive, with Tesla stock up about 8% or $90 per share, just after market open as I am recording. Humorously enough, the lowest price target on Tesla stock on Wall Street is $87 per share, so in the matter of a few hours, Tesla has added the entire value of that lowest price target. So let's look at the numbers here. For those of you that haven't seen it yet, Tesla delivered 90,650 vehicles in Q2. That was well above FactSet consensus estimates of 72,000 vehicles, as well as above reports of whisper numbers in the 80,000 range. For production, Tesla reported 82,272 vehicles produced in Q2. Alright, so let's get into these numbers a little bit. As we talked about earlier this week, my forecast for production and for deliveries was about 94,000 and 96,000 respectively. But even though the numbers did come in a fair amount below my most recent estimates, these are still very strong numbers from Tesla. The 90.6 thousand delivery number is up about 2.5% quarter over quarter from Q1, and it's only down about 5% from Q2 of 2019 year over year, despite the obvious challenges with a global pandemic. In fact, if we look at the total first half of 2020, so Q1 and Q2 combined, Tesla has delivered about 179,000 vehicles, up 13% from 2019. Tesla's production in the first half of the year is up very similarly, up 13% from last year to 185,000 vehicles produced. These increases have happened despite the fact that Tesla's Fremont factory was closed for about 7 weeks during the first half of the year, or more than 25% of that time. For Tesla to put up year-over-year increases in the first half in this type of an environment is a testament to a couple things. Number one, the strength of Tesla's demand. This is something that Tesla has been questioned on basically since the beginning of its existence, and yet even in a challenging macro environment that is seeing other automakers' sales decline by 20-30%, Tesla is selling for the most part every single vehicle that they can produce. In case it's not clear, that means that the latent demand for Tesla's vehicles far outpaces where their production level is today. Tesla's original guidance for the year was to deliver more than 500,000 vehicles. That's less than 1% of the total market. BMW alone does about 2.5 million vehicles a year. At 500,000 vehicles, Tesla is not demand constrained. I think with these numbers we can put that issue to bed for quite some time. That doesn't mean there won't still be demand pockets where Tesla has to maybe pull some levers like offering free supercharging to boost the end of a quarter and to help clear out inventory in specific regions, but overall the picture is very clear and very strong. The other critical point on these year-over-year increases is on production. Tesla grew production 13% despite Fremont being closed for 7 weeks. Tesla's production in Q4 of 2019 from Fremont was just shy of 8,000 per week, so to be down for 7 weeks, that means that Tesla missed production from Fremont of potentially about 55,000 units, maybe even more when we account for the Model Y ramp up. As I said, Tesla's production in the first half of the year has been about 185,000 vehicles, if we assume that lost production was around 55,000, which doesn't even factor in downtime at Shanghai, by the way. If we add that 55,000 to Tesla's production number, that would have put them around 240,000 produced in the first half, compared to Tesla's deliveries in the first half of 2019 of about 164,000 vehicles. That would have put the growth rate for Tesla in the first half of the year at about 50%. Clearly, as Tesla's production continues to ramp in the second half of the year, without the downtime, Tesla would have been well on their way to exceeding their delivery guidance of 500,000 for the year. I want to talk more about production in a second, but first let's round out the discussion on deliveries. With the numbers now released, of course, the attention turns to the earnings report, which should happen in late July. And this time in particular, there's a lot of focus on profitability because, as we've talked a lot about, if Tesla produces even $1 of GAAP net income for the quarter, they then become eligible for S&P 500 inclusion. Of course, if we look back at Q1, Tesla delivered about 88,500 vehicles, and they were able to post a $16 million GAAP profit in Q1, but that was aided by more than $350 million of regulatory credit sales. If we look a little bit further back at profitable quarters since the Model 3 introduction, Tesla has had 5 of them. Deliveries in those profitable quarters have ranged anywhere from 84,000 vehicles to 112,000 vehicles. In fact, in quarters when Tesla has delivered more than 80,000 vehicles, of those 6 quarters, they have been profitable in 5 of them. The only exception to that was Q2 of 2019, when Tesla delivered about 95,000 vehicles and did not post a profit. But that quarter had a lot of profitability headwinds, including about $120 million of restructuring charges. And this was also the first quarter where they significantly ramped up the Standard Range Plus Model 3, which obviously was a lower margin than what Tesla had delivered up until that point. And then they also introduced the Raven powertrain for the Model S and Model X, meaning they had to discount their older inventory on those vehicles with the older powertrain. They also had foreign exchange profitability headwinds, so just a lot of things working against them that quarter that don't necessarily apply to this quarter. So personally, I believe that the outlook for profitability for Tesla's Q2 looks pretty good, but it does hinge heavily on what those regulatory credit sales end up being for this quarter. We don't have a good way of forecasting them. The $354 million of regulatory credit sales that Tesla sold last quarter, I believe, was an all-time high, seemingly driven by Tesla's agreement with Fiat Chrysler to purchase credits. But with Fiat Chrysler's deliveries in Q2 being down and Tesla's deliveries in Europe, where Fiat Chrysler is buying those credits from Tesla for, being down, then we may not see the same level of regulatory credit sales from Tesla in Q2 that we saw in Q1. Again, we don't know a whole lot about this agreement with Fiat Chrysler, but there has been speculation out there that the agreement is straight line in nature, so not necessarily dictated off of Tesla's deliveries in a given quarter or Fiat Chrysler's needs in a given quarter, but instead based off of their annualized estimated need and then just allocating that evenly throughout the 4 quarters of the year. If that is the case, then perhaps we do see similar level of regulatory credit sales. Even setting aside those regulatory credit sales for 2020, Tesla actually has said in their 10-Qs for quite some time that they have about $140 million of deferred regulatory credit revenue that they have not recognized, that is expected to be recognized sometime this year. If that happens in Q2, that could be a nice tailwind to profits. And then we also have the tailwind of Tesla delivering stop sign and traffic light control for their full self-driving feature set, which will allow them to recognize a nice chunk of revenue that'll all fall to the bottom line. Considering all these factors, I do think it's more likely than not that Tesla does post a profit in Q2 and thus becomes eligible for S&P 500 inclusion. All right, let's shift over then to production. As I said, my most recent estimate for Tesla's production was about 94,000 vehicles. I was way too high there. That's not very close. We went through all the numbers though, and I stand by the thought process. I was just too high. I think I got too optimistic based on the Model Y VINs that we had seen reported and the production reports from Gigafactory Shanghai. This isn't a capacity thing. Tesla had more than enough capacity to deliver on my estimates, so it must be a speed of production ramp back up after the significant downtime, and how that re-ramped production was impacted due to social distancing at the factory and things like that. And not just for Tesla, but all this goes for their suppliers as well. In terms of the split between vehicles, I was high in both buckets. I had S and X at about 8,500, and then Model 3 and Model Y combined at about 86,000, versus Tesla's report of about 6,300 Model S and X produced and about 76,000 Model 3 and Y produced. That S and X production rate is really telling. We can isolate those. Obviously, both are just produced in Fremont, versus Model 3 and Model Y, we don't know which factory that production is coming from or which vehicle. But for S and X, if we look at the 6,300 produced, Tesla had roughly 7.5 production weeks after accounting for downtime. So in those production weeks, they were only producing about 850 Model S and X vehicles per week versus about 1,300 per production week, excluding downtime in Q1. Basically only 2/3 the rate from the previous quarter. If we assume that the Model 3 production rate was similarly only about 2/3 of the production rate from Q1, that would put Model 3 production for the uptime weeks in Q2 at roughly 3,700 per week. And then if we put Model Y at 10,000 vehicles produced for the quarter rather than the 13,000 that I had yesterday, and lower Shanghai by about 1,000 units or so, then we come out to Tesla's 82.3 thousand production. So if you're watching on YouTube, you can kind of see how I would roughly have this split out. But the logic of Fremont just taking a little bit longer to ramp up than what I had forecasted yesterday does seem to make sense. I should have just stuck with my estimates from May, because in May I had estimated production of 83,000 and deliveries of 88,000. Those would have been very close. I don't bring that up to say, hey, look, I was right at one point in time. That's not important. But what is important is that when I walked through that forecast and I had Q2 production at 83,000, my production forecast for the balance of the year led me to about 555,000 vehicles produced in 2020. So if Tesla came in pretty similarly to that forecast for Q2, that level of production is still very much on the table for this year. We only got a small additional nugget of information in this production and delivery report, but Tesla did say, quote, "While our main factory in Fremont was shut down for much of the quarter, we have successfully ramped production back to prior levels," end quote. Again, in Q4 of 2019, Tesla was producing about 7,900 vehicles per week out of Fremont. That's 410,000 vehicles annualized. Then we know that Shanghai is approaching 4,000 per week. That's 200,000 vehicles annualized. So Tesla's production right now should be in excess of 600,000 vehicles when annualized, and then the Model Y is ramping up. To deliver more than 500,000 this year, Tesla will have to deliver about 321,000 vehicles at least in the second half of the year, meaning with Tesla's low inventory now sitting at about 22,000 vehicles, second half production would have to be in that 320,000 vehicle range at least for Tesla to make that level of deliveries. So that production rate annualizes to about 640,000, but Tesla is already right now at least 600,000, and they said in their earnings letter last quarter that they plan to have an installed annual production capacity of 790,000 at some point in 2020. So if we're at 600,000 now, and they can get to 790,000 by the end of the year, the midpoint of those, assuming it ramps up throughout the year, is 695,000. That would mean for the second half of the year, a pretty clear path to about 350,000 vehicles produced, when Tesla really only needs to produce about 320,000 to have a shot at beating guidance. So that is very much still on the table for this year, and I continue to expect Tesla to exceed that level. The last quick thought for today on this release, Tesla drew down inventory by about 8,000 vehicles. Cash flow for Q2 is going to be absolutely bonkers. I've gotten some comments about people being excited about that hitting the profitability line. That's not really how it works for GAAP accounting. You account for your cost of goods sold at the time that revenue is recorded. So there's no big profitability tailwind from those inventory vehicles being delivered, but you do get a huge tailwind on cash flow. Tesla already spent the cash to produce those 8,000 vehicles. Now they're just going to sell them all and bring all that cash in. So that'll definitely be a fun number to look at with the Q2 results. Anyway, that'll wrap it up for today, and for me for the week, I'm going to enjoy some time off for the 4th of July holiday. Hope you all get a chance to do so as well. Everybody be safe travels if you are traveling, and I'll see you on Monday for the July 6th episode of Tesla Daily. Thank you.